Good afternoon, everybody. We're really pleased that so many of you have been able to make the time to join us today at the Impact Investing Institute for our discussion on people-powered investing, tools for individuals to invest for impact. I'm Jamie Broderick, and I'm a director at the Impact Investing Institute. My background is in wealth management and asset management. I'm pleased to welcome to the discussion three people that have a lot of experience in guiding individual investors toward creating impact with their investments. They are Vidhya Alakeson, Chief Executive of Power to Change, Daniel Brewer, Chief Executive of Resonance, and Lyn Tomlinson, Head of Impact and Philanthropy at Cazenove Capital. We're going to start with a discussion with our panelists, then we'll move to your questions afterwards, which we are really looking forward to. So please type directly in the Q&A feature, which you should see at the bottom of your Zoom window. And even if you don't have questions of your own, take a look at the Q&A box anyway, because you can upvote other people's questions. So let's start by having each of the panelists give a brief description of themselves and their organizations. Lyn, can we start with you?
Yeah, sure. Hi, Jamie. My name's Lyn Tomlinson, and I'm Head of Impact and Philanthropy at Cazenove Capital. For those of you who don't know Cazenove, we are the private wealth management arm of the Schroders Group, and we specialise in advising clients who sit in the sort of ultra high net worth and high net worth segment.
Great. Vidhya?
Hi, I'm Vidhya Alakeson. I'm the Chief Executive of Power to Change. We're an independent charitable trust set up to support community-led businesses. So we've supported about 1,000 community businesses since we got going in 2015. And our real relevance to this conversation is around community investing, so community shares and community bonds.
Great, thank you. And Daniel?
Hi, yeah, Daniel Brewer at Resonance. It's a company I set up 18 years ago as an impact investment fund manager and deal arranger, and we've got a little over £200 million other people's money we look after, including a number of funds that are invested in by individuals, both advised and unadvised, but we also do some direct deal arranging where investors can pick their own investments, typically through some crowdfunding platforms.
That's great, thanks for that, and welcome to the three of you. So it might be helpful actually if we also got a bit of an intro to our audience. So we have two poll questions for the audience, which Lizzie will put up in a moment. I think you have to answer both questions in order to submit them. So Lizzie, can you show us the questions? And for those of you, you can answer, this is a little bit complicated, you can answer either as yourself as an investor, or if you're advising clients, express the view of most of your clients. Okay, let's take a look. Any reaction? Daniel, you've asked this question before, so what's your reaction? Is this kind of a typical cross-section of the population?
Yeah, no, I suppose I haven't seen such a high proportion of seasoned people who would self-classify themselves as seasoned impact investors. So I think it is indication that things are improving, but obviously you know, this is the Impact Investment Institute, so we would expect to have some people on there, but it's really encouraging also to see people that this is totally new to, because the whole point of this webinar is to show that it's possible. Yes, obviously encouraging that nobody thinks we should only be thinking about financial return. I think Friedman's 50-year-old narrative is slowly dying, which is fantastic. Yeah, it's an interesting, positive mix of actually, yeah, we can do more than just screen out the negative, which, you know, 10, 15 years ago would have been a much higher proportion of a general population anyway. I know it's a small subset, but yeah, very interesting.
Okay, other reactions? Lyn, what's your view on that? What are you seeing that surprises you?
Well, unfortunately, I had to go and turn the smoke alarm off because my new nanny's just set the kitchen on fire. So I have no idea.
Okay, Vidhya, why don't you? So Lyn, take another look, and then we'll go to.
I thought I heard a smoke alarm, but I wasn't sure. So I think what's encouraging is actually in the second question, the percentage of people that are interested in investing in ventures contributing to solutions. I mean, it's not a either philanthropy or investing, impact investing, that both are valid and play different roles, but it's encouraging to see people about kind of impact investing rather than just philanthropy as the way that they can create impact. So that, I think, for me, is really encouraging.
Yeah, I mean, and it's also great to see that avoiding harm is the sort of least interest of the perhaps the group today, which is great. So we're all, talking about the same thing when we're talking about impact, which I think is really important.
I think really, I mean, it feels like the avoid harm, no sin stocks is disappearing. I mean, people are less and less interested in this. And I would just observe, I mean, in part out of deference to Lyn, that the low returns for philanthropy, remember the question was about impact investing. So it's not a question about philanthropy, it's a question about impact investing. So I think what we're saying is within impact investing, philanthropy doesn't play a large part. Philanthropy plays a large part in a different part of our lives. Great. Okay. Well, thank you. Thanks to everybody for that. Now let me move on to the question. So what are some of the ways in which investors can flow their capital into impact? And this is really about people, right? Individual people. So it's not about institutions moving capital, it's about individual people. And what are some of the ways that investors can flow their capital into impact? Lyn, what's your view on that?
So I think there's two routes. There's the sort of advised route, which tends to be where we've got a wrapper that the advisory community is familiar with, generally with tax relief. So, venture impact funds, EIS, CDIS, SITR funds. I'm sure Daniel can talk more about that. But then there's also the direct, which is through crowdfunding and community shares, etc. So there's a really broad set of opportunities, and I think that's probably a challenge for some of the advisors on the call as to what role they play in that distribution piece, because it's different depending on what a client wants to achieve.
Okay, but that's an important distinction between the advised and the direct. I think the behavior is going to, and the vehicles are going to be different. Vidhya, in your area, what's the most common way for people to get capital into the space?
Yeah, so I mean, all of the stuff that we've done is really around the direct investment. We invest as an institution, but invest alongside retail investors, and that's really community shares and community bonds. So I mean, just to give you a sense of the community shares market, between 2012 to 2019, there was 130 million invested in community shares by about 100,000 people. So many of those investments, and that was in about just over 500 community enterprises and community businesses. So many of those investors will be very small, but some of them will be larger. And I think for the end organization, one of the things that's really important, or two things are really important about community shares. It's very long-term patient capital, so unrestricted capital that community businesses can really build off the back of. And the other thing is that any investor is investing on a pari passu basis. So whether you buy £100,000 worth of shares or £10 worth of shares, you have the same sort of democratic role within the organization. So you buy the same kind of level of rights regardless of how much you own. And I think the challenge of the direct, that I recognise that for many people, the direct route is challenging. So we've done a lot of work with the community shares market to try to improve standards, create transparency in order to make it easier for people to go either direct route or for financial advisors to advise them into community shares. But recognising that it's not the most straightforward route for a lot of retail investors.
Vidhya, could you give an example of a community share? I mean, we actually have a very sophisticated audience, but I wouldn't mind, nevertheless, a little bit of a definition of how a community share works. What's the return, typical return, and what kind of project would it fund?
So I'll give you an example of one that we supported, which is Leeds Community Homes. It's a few years ago now. Daniel will have hundreds of examples as well, I'm sure. So they built a 16-home, so in a relatively deprived part of Leeds where affordable housing is a real challenge, they wanted to build a 16-home scheme. So they raised about £300,000 of equity capital through community shares to build the scheme. And alongside that, I mean, one of the other advantages of this approach for the end organisation is it has a really good leverage potential for other capital. So with that 300,000, they were then able to borrow the rest of what they needed, and there was some grant capital in there as well. So we see overall about a 1 to 1.75 kind of leverage ratio for community shares. The shares are so that the return is relatively small, but in the current environment of low returns or zero returns across the board, you may still get a community bond with a 4% return in a way that you're not going to get much elsewhere. So, you know, in a different world, it seems concessionary, but in the current environment, much less so. And you can withdraw the share, but on the terms set by the end organisation. And I think, you know, the work that we do as a foundation is very much often in the early stages of community businesses, and some of the community share issues that we might contribute to are relatively high risk. But for some of the community businesses that go on into maturity, they're raising share capital as mature organisations, and they're much more stable, the returns are much more reliable, and the withdrawability is much greater. So, you know, for an individual, say high net worth, that's a more attractive bit of the market potentially to consider. I think the other thing that's worth saying is that according to the mutuals regulator, very few community businesses that have raised share capital have then gone under. So in terms of survivability of these kinds of organisations, it's really strong.
Interesting, you make the point, I mean, you've made a very important point, I think, which we should emphasize, which is that when we had interest rates of 4 and 5%, then community shares looked modest. At the moment, gilts yield about 0. And I believe NSNI just went to 0 for its deposit this week. So all of a sudden NSNI is at 0. That puts some of these other investments in a very different context. Yeah. Daniel, I mean, we've already mentioned a couple instruments. What kind of instruments do you work in, and what are their peculiarities and interesting features?
Yeah, so we at Resonance work across the board, but the community shares, I think one of the things that's interesting is it feels like it's a new instrument, but really it's been around for 170 years, and mid 1800s it was set up as out of the cooperative movement, but somehow in the last 20-30 years it's caught a new momentum. It's a really very effective way of raising local money, but it's in small amounts, so it takes a while to build that track record. I think the bonds are worth mentioning. One nuance that we're really keen to do more of with some of our partners like FX and Triodos and Crowdfunder. They're all kind of these platforms that we use for these direct distributions, but they're eligible to be wrapped in an innovative finance ISA. So actually you can get with a bond, you can actually get your interest tax free up to the first £20,000 that you put in. So that makes a real difference to how efficient it is for individuals to invest, and it starts to look a little bit like a product that advisors can come alongside and help. But often, I completely agree with how Lyn characterized this. If you and investors really have to work out what they want to do. Do you want to pick the individual investments and enterprises yourself, or do you want to invest in a portfolio of a fund, or a portfolio of loans, or a portfolio of investments? In which case, one is, oh great, I put a little bit of money in and I get exposure to 6, 10, 20, 30 different underlying enterprises, or when I put some money into this particular one, and you have to be quite deliberate as an individual about which is if that's important to you. But some of our funds that really do take individual capital, put all of it directly into enterprises that need it, but do it in a diversified way. That has gone down really well in the advised community. We have had some individuals investing, but is these SITR funds, social investment tax relief funds. And they've mirrored the EIS World Enterprise Investment Scheme, which is for private companies. Unfortunately, we've had to pause taking on any new money until we get the government to confirm its commitment to this particular scheme, because they were due to this time last year to announce it in the budget, an expansion of the scheme, and without that expansion it actually closes. So if there are any your keyboard warriors out there who want to write to Rishi Sunak or Jesse Norman at the Treasury to tell them to keep it alive, then it's been great. We've had mobilized 200 individuals, 14 wealth managers, a small number of millions, but it's been a real help to some enterprises getting access to capital they just could not access without paying through the nose for. And I see on the chat one of our investees, Chris Rawlins at SoFab Sports, who's joined in. So good to see you, Chris.
That's great. Living proof that SITR is doing good out there in the world. So we talked about a number of different instruments. I'd also like, so one of the things you have to decide is whether, as an investor, whether you do it alone, whether you go with your advisor, but also most clients, most investors are doing good across a range of options, including philanthropy. So I wanted to ask you, maybe Lyn, starting with you. So what is the right mix of investment and philanthropy? I mean, how do individuals think through where they try to do their good?
So I think, I mean, that's very personal, but if you look at most people who establish a charity, they tend to give away sort of 3 or 4% each year of the assets and hope that the investment returns keep up with that over the long time. I think what we're seeing a lot more of is people looking at the whole pot, so everything that they are doing, whether that's their own personal wealth, where they're investing in sort of listed equity markets across that ABC impact spectrum that you put up on the poll, Jamie, and then really thinking about how they can maximize the impact of all of their charity. And so we have clients who are, you know, making interest-free loans to social enterprises and charities, people who are investing in impact venture LPs, as well as a sort of normal portfolio that you might expect to see in a discretionary fund management portfolio. And I think for me, what's really been interesting and something that I'm really passionate about is that I know we have clients who are funding really interesting, you know, areas around homelessness, and we have the likes of Daniel Brewer and his fabulous homeless property funds, and Social and Sustainable Capital with their Women in Safe Homes funds. And how do we get those people who are really funding, you know, very specific areas to actually invest as well? I think is a challenge, but really interesting.
Well, I would just observe that, as we just said, the interest rate environment changes the context. You mentioned interest-free loans. I'm making interest-free loans to the UK government. In other words, I give them money and they give me absolutely no interest in return. So I think some of these things that looked quite concessionary in the past, I think look less concessionary when inflation and interest rates are low. Okay, I wanted to ask you, Daniel, did you have something to say?
Well, it's just the mention of some of the, you know, the property funds that we run and others. It sort of reminds me of almost what's nearly impossible for individuals to invest in. But there's a whole investment market that is classified as basically private equity, as far as the regulator is concerned, that I am not allowed to market to an individual at all, however wealthy they are. And mostly the response I get from advisors is, oh, that's a quick geeky term, unregulated collective investment scheme. No, thank you, because there've been too many complaints to financial ombudsmen around mis-selling. So it's actually impossible for individuals to get access to the vast majority of private equity investments. The two ways through it. One is SITR and EIS schemes, so there's tax relief schemes that have an exemption under that, and the other isn't yet existing as far as I'm concerned, but it's just about to come. So there are 2 investment trusts that are just about to launch, which should be eligible and accessible by individuals, and they will actually have a portfolio of these private equity funds, like the ones that we have, that you can't invest in directly, but you can invest in the investment trust. So Snowball is one of them, and I'm a trustee of a foundation that's one of the partners in that. So I've seen that journey over the last 4 or 5 years, and I think their first close was today, bizarrely. So I don't think you can yet invest in it. And the other one is still in formation, but has been spawned by Big Society Capital's work to date. And yeah, I'm really excited about both of those. So when they go live, then actually there's a chance for individuals to put money into what looks like a normal investment vehicle as far as the regulator is concerned, but actually the money actually goes into advancing new things. And that's been my real struggle with the ESG world, which, I'm a great supporter of it. I'm a really big fan of it. But when I buy a share in one of these ESG funds, and they tell me that their best performing stock is Shimano. From an impact perspective, I'm thinking, well, money buying a share in Shimano doesn't help Shimano do anything new. All I'm doing is buying the share from somebody else. So it's a illusion that I think a lot of individuals don't understand, is that when they buy, you know, an investment that is broadly a trust or a fund or full of public equities, their money is not available to those enterprises to expand their operation at all. It just doesn't change it. So you can be an impact through being an engaged investor, you know, engaged shareholder. You can kind of write and say, I these things matter to me, but the money doesn't make any difference. Whereas the private equity world, the world that we're talking about, there are ways through, but it is getting easier. But yeah, there are some innovations that are still coming. So
yeah, I think I would also give you a little bit of hope, Daniel, in that you know, wealth managers are really grappling with this whole de-equitization of markets more generally, and what that actually means is that we're having to segment our client base more and really think about this broad brush retail classification that's, you know, there for very good reasons to protect consumers, but actually what it does is it sort of stops us being perhaps as innovative as we would like to. So because of that, you should start to see, you know, much more client segmentation within wealth management, so that people can actually take part in GP and LP structures, and that will filter through into, you know, internal investment processes and a little bit more on innovation. So, you know, investment trusts aside, I think I am starting to see certainly movement in that area as well, which I think will help scale this market more generally. Because even if the investment trusts get away, there may be some areas of the market that doesn't cover and cater.
Absolutely. I want to move on. I want to ask a question about community-based investing, and in particular, whether the pandemic has created a new, more intense focus on community-based investing. Vidhya, do you have a view there?
Yeah, I mean, I think we see from opinion survey after opinion survey, research after piece of research after piece of research, that there is a new salience for both local and community among the public. So, you know, community in various bits of research have come out recently is the one sort of highlight of what has been a pretty terrible period over the last 6 months, and looks like it's going to continue to be pretty dire for most people. So I think there is a really good foundation for assuming that community investment is going to get more interesting to people. And I think I'm sort of hopeful, I suppose, that might encourage more direct investment, because I think the ability to invest in things in your own community is something that I think will become more attractive to people, particularly as they are more embedded locally now. So, you know, the change in the patterns of work, the fact that we're more embedded in our local communities than in kind of city centre communities, or, you know, that kind of commuting lifestyle that many of us had, I think is changing some of the dynamics. I think we're yet to see whether that will filter through in a big way into a renewed momentum behind community investing, but I'm sort of hopeful that it will. And I think that background change, combined with easier access to the opportunities that Dan and Lyn were talking about, could create a really powerful momentum behind community investing.
Daniel, you have Resonance has some location-based investment strategies. What's your perspective on this?
Yeah, I suppose there a couple of points. One is the momentum is definitely increasing, and I think we saw it a bit in response to what is our national identity, or what is our identity, with some of the Brexit debate that's been going on, is saying, well, actually, what is important to us? What are the communities that we can connect with, that we want to be part of? And I think it's incredibly important, so that we maintain this ability to have conversations with people that we have something in common, but actually we might disagree on some things. And I think there's a real important part of society's fabric that this particular type of investing creates a common denominator rather than a common fracture. So we have a fund at the moment that is busy deploying very small amounts of money to seed fund new community enterprises, because over the last 15, 18 years that I've been doing this job, we have seen the value of at the longevity of communities, particularly owning the assets in their neighbourhoods, and especially assets that are used by the public. So whether they're leisure centres or shops or other things like that. So you kind of get this sense of, hang on, we own this together. But interestingly, and we've got a live share offer at the moment, based in Cornwall. It's on FX if anyone wants to invest, and it generating a 3.5 to 4.5% return. So, but it's got a 10-year track record now of delivering returns every single year. We've got just over 200 investors, nearly £1 million worth of equity. It's got real estate backed by it. The revenues are stable. Actually, what's not to like? But it's just over now. Just over 50% of the investors, well, at least their home postcode that we know about, is not from the geography at all. And that's similar with our SITR funds. We have kind of geographic regions, but we also have an impact theme. So we tend to produce investment products that have these two things. One has some kind of geography. Some of it's very, very tight. It might be Launceston, where I live in Cornwall, or it might be Cornwall wide, or it might be the whole of the Southwest. And then it has another theme, which might be, dismantling poverty or providing, accommodation for vulnerable adults. And I think that's good, because it allows people to choose whether they, okay, I'm investing in Cornwall because I love Cornwall, and that's, I almost don't care what it's doing as long as it's in Cornwall. And other people go, well, actually, I really care about homelessness, and the fact that it's in Cornwall is great, but if it was in Bristol, I'd do it there too. And allowing people to navigate the value set that they have. But yeah, it's been really interesting for me to see community-led exercises being attractive to people who either feel they have a connection, or maybe they did live there, or they've got family there, or history, or they went on holiday there. Whatever it is, that's a hook, but it's definitely not the only hook. And people are embracing this as a national response to specific issues they care about. And I think the UN SDGs sometimes become quite a useful tool, particularly for client advisors, so financial advisors, to say, well, look, you as an individual, which of these 17 which 3 typically would you choose to be most important for you? And I think when you have that conversation, then a client advisor, an advisor, or even you as an individual can go, well, look, let's stick to those things, and let's go and find the things that are important to me, because we all value slightly differently.
So can I just add to that? But it's actually really important for the end enterprises, particularly in more disadvantaged parts of the country, that we do get a mix of capital coming in from elsewhere and local. So yeah, that 50-50 mix of local investors alongside national investors or even international investors, because in more disadvantaged communities, you're not going to actually raise all the capital you need to raise from your local investors. So as well as it being an advantage for investors, it's actually a real advantage for the end enterprise if we can get that mix. So I think we're seeing that quite commonly in share raises, that you're getting that blend of national investors and local investors, and it really matters.
That's very interesting to me. So you're saying it's not necessarily the ideal that all the capital is sourced locally. You do want that mix, which leads me to ask Lyn, for example. You run a national operation. Most of your people don't come from whatever community it is that's being funded. So how do you flow that wholesale capital into these spaces? And I guess what Vidhya and Daniel are saying is that it's actually quite welcome. It isn't their objective to source everything locally, but engage people from outside. But I guess my question to you, Lyn, is how do your clients who aren't from that place get excited about providing funding for that place? Because I know some of your clients do invest in place-based investment.
Yeah, so, well, I think there's a lack of opportunities, isn't there? So, I mean, we have the Bristol Southwest Fund, and we have clients who are from London invested in that, and we have people who are actually from Bristol and know the real issues that there are in that area. So I think what Daniel said is that and it gets to the heart of why this type of investing is so valuable for us and for clients, is that there's real measurable impact that you can report on and show from your capital allocations that you just don't get in listed markets. And I think for most people, being able to go beyond listed markets is more important than actually whether it's in their backyard. I mean, from a philanthropic perspective, obviously there's a real link between where people grow up and where they want to make a real difference, and that's why we have 46 amazing community foundations, working in those areas who really understand the need. But I think from an investment perspective, it's much more about the theme about helping people in underserved areas, irrespective of location, in my experience anyway.
I mean, several of you have said that you really need to move away from listed equities in order to bring capital and start providing solutions. And I totally agree with you, but it does mean that you take clients into unfamiliar territory, both in terms of the due diligence on the individual project or in terms of the vehicle that you're offering. So it's a more complex area. It's not, I think everybody knows how to buy and sell a stock, but how to put capital into a social enterprise in Bristol, that's a little bit more complicated. So I wanted to ask you about the role of advisors. But before we do that, so I think the role of advisors, I'd like to get from you a sense of that. But before we do that, I'd love it if Lizzie could give us the next 3 questions for the audience. So what proportion of wealth would go into impact? What proportion of wealth is already in impact? And which pots of capital would you or your clients want to invest from? So I think we've got a critical mass here. So why don't we take a look?
Yeah, great. Well, I mean, there's obviously a latent demand, isn't there? It's saying, well, actually, we 73% haven't got, want to move somewhere else into the space, or at least a proportion.
Well, Daniel, so do you want to comment on that first question? So what proportion of their wealth should be in impact?
Yeah, well, I mean, I think you have to take questions 1 and 2 together, don't you? So the ambition there is spread, and I think that's really what we see quite a lot. There are a few people who want to be part of the 100% club, and there is a 100% club. It does exist, and then there's the majority of people who actually want to go, well, do you know what? I'm more comfortable with certain, the majority of my wealth being in something that, is more traditional, and I feel comfortable or understood or advised in. But I definitely want to have some of my money actively used to contribute to solutions. And it's clear that either the opportunities or the routes through are not yet there, because what today's position of people's wealth is in the 0 to 20%, and I would hazard that quite a lot of it will be in the 0 to 5, and maybe in the just 0 to 1%. But we'd have to break this down a little bit further.
And Lyn, what are you seeing here? Is this what your client base looks like, or are we in a room full of impact aficionados who are overperforming?
No, so if you took the client base as a whole, obviously we have about 7 or 8% of our clients who are investing in a more values aligned way, which is still a large amount of assets under management. I mean, what stood out for me from that poll is that how low the donor advised fund or charity investment was, because I just get so excited about that capital, because it's just got the real opportunity to be very innovative. It's already left the client, they can do so much more with it, and it's so mission aligned. So I thought that was really interesting, actually, that was the lower compared to their own private money.
Yeah, I think the use of Dapps, I mean, to the donor advised funds, should permit people to be a little bit more courageous about their investing in impact, because the money has already left the room and it should be available. I mean, that really should open up all kinds of options for people to be a little bit more ambitious about the impact they're creating. And yet I think what we find is that a lot of Dapps are actually being managed quite conservatively. And I think there's more we could be doing there, I think.
Well, for want of being a little bit controversial, in our experience of trying to persuade Dapps directly to make decisions to put a product in front of their clients that might actually do some good, and then they'd still have access to it to give it away, is so difficult for to engage with, because I mean, firstly, the commercial interest of actually just keeping it in their own hands rather than handing it on to a different fund manager is quite compelling. The second is that they're worried it's going to confuse the message and saying give. Oh, but we're going to do investment, and then we're a bit worried they're going to get cut out of the loop. But also the confusion around the regulatory bit. Where we've had success is when it has been driven by individuals. So when an individual says, "Oh, I've got some money in donor advice funds," I shall name none of them, but that have then responded and said, "Well, of course, if you want to do that, then you can. It is possible for us to hold it in that account." And when driven by people, we found that most donor advice funds actually respond positively to making that happen. They don't shut down their donors. They just shut down us as product providers, and that's fine. That's a fair way round. But there's an awful lot of money there that is not yet being invested for impact, whilst it hasn't yet found a donor home. And I suppose they're also a bit nervous about the illiquidity of it. If the donor suddenly said, "Well, I want to give this away now," they go, "Oh, well, I've just tied it up in a 7-year private equity fund." And it's like, well, if you don't do that with a relationship with your donor, then that's a problem.
Well, I mean, as somebody with a wealth management background, my advice would be to talk to your advisor about that. But I do want to talk about advisors, and actually, somebody needs to tell me whether the poll has disappeared from your screen, because I can't tell. Okay, great. So let's talk about advisors. And Vidhya, you said something. I was interested to hear that sometimes advisors do get involved in community shares, because it's typically a direct investment, but the advisors also get involved. So I guess the general question for you and your two colleagues: what role should the financial advisor play? Which investments work really well? Is it on a DIY basis, and which ones really need advice? Do you have a view there, Vidhya?
I think it's more one for Lyn than for me, and that most of what we do is kind of more on the DIY end. So I think Lyn's better placed to answer that one.
But you didn't you say that sometimes advisors do get involved in community shares?
They have done, but that's not really our experience. I think Dan and Lyn are best placed to answer that one.
Okay, Lyn?
It's coming to me. So so as I alluded to at the beginning, I think there are investments that fit very well in the regulatory environment that advisors work in, and they're the tax efficient products. But I don't think we should underestimate the value of referrals or signposting. And in order to be able to do that, you do need to segment your client base and not have retail classification for everyone. And you also need to know the market, and you need to know that resonance exists and community shares exist. And so there's a real need for improving the fluency so that we can get a sort of more consistent client experience, because there's pockets of expertise within the broader wealth management community, but the whole workforce aren't doing this day to day. So I think education's a big part of how we improve that. But I do think if we all understood the market and were referring effectively, you would increase the flow of capital. And Daniel, I think you've had referrals directly from wealth managers where it hasn't actually been advised, but I'm sure they're normally, they can be quite material, even though they're small numbers in terms of individual clients, but they can be quite material in terms of assets.
Yeah, and so I agree with that. There are ways through, and where there's the will, there's a way, and it depends on that relationship with the client and the client advisor. But I think I've heard you say before, Lyn, that actually when that happens, the richness of the relationship between client advisor and advisor, this is the deal that they talk about to their friends. They don't go, "Oh yes, I'm in some listed stock." They go, "Oh, do you know what? I'm investing in a fund that's dismantling poverty in the southwest of England. Oh, I've got this community share that's housing homeless people in Cornwall." It's the thing that the client talks about. And I know Worthstone, who work across a number of different advisors, talk about, you know, if you want relationship rather than just transaction and a fee, thank you very much, then that's, I think I'm right. I've heard you say that, Lyn. Is that, I haven't.
Yes, exactly. No, you're right. It's you know, well, if you buy something terrible with a client or you buy something good, it's always 90% of the conversation. I would say having something that's very purposeful to talk about at the end is really great. And to be honest, clients don't care whether you're overweight European equities or underweight Asia, you know, et cetera, et cetera. They want to talk about themselves and their family, and you know, it's all that great conversation, client relationship skills, which I think this area is fantastic for developing.
I think it's true that the persistency of impact investments is much higher than the persistency of conventional assets, because you get the client emotionally engaged, which is, you know, a good thing. It enhances the relationship and makes them more tolerant, I think, of mishaps or, you know, underperformance or whatever. I think there's much more of there's a more balanced engagement by the client in the investments. I think it's really quite powerful. Again, I come back to the community-based investing, where the investment in what you're actually delivering, the solidarity with the rest of the community. I mean, that's just enormous, and that's not something you get when you invest in BP. Well, not BP.
There's one I mean, one challenge and a solution that we found with financial advisors, particularly related to community shares. The challenge is when they are timed, and typically the majority of them are open for, you know, 2 or 3 months, and then they close. And the struggle for an advisor to go through their full compliance process, to prep the product and then handpick half a dozen of their, you know, suitable clients, and then book a meeting with them to set it up, and sometimes then arrange a meeting between the investor and the actual product provider, you know, just doesn't fit into that 2 or 3 month window. And we found that to be really challenging. And I think that the 2 ways around that we found, one is to encourage advisors to ignore the close, and certainly some of the share offers that we've been working on, we sometimes get to the end and we go, all right, that's done, but it doesn't mean that we can't take additional capital outside of that period. And particularly if you know, there's a significant investor, you know, that typically they can invest up to £100,000 is the maximum you can to do as a community share advisor. And then, you know, actually we can do that any time of year. And once you're an established community business, you've really just got a perpetual need to raise more capital. So that conversation is live. So my encouragement to advisors is, you know, find those share offers that have been around, or those community benefit societies have been around for a little while, and have conversations outside of the capital raises, if that's the barrier. And the second mechanism is using discretionary funds. So some advisors have got some client money on their discretion, and suddenly the transaction becomes a lot easier. And we know that some advisors have gone, right, actually I want to do a £600,000 contribution to this £1 million capital raise, because the organisation is big enough to do it, it can tick that boxes, but actually I'll make that one investment, which is terribly efficient for us as advisors and community share offerers. But underneath that £600,000 contribution are 100 different individuals, and that's you know, just a super efficient way of making it work. And I, you know, haven't seen that happen a lot, but it has happened, and it does work, and it is complying with FCA rules and, you know, maximum share.
So Daniel, this takes me to one of the questions, which is, from Lisa Ashford, can community shares ever become mainstream? Well, I don't know if Vidhya, whether you have a view on that, but I mean, it's an interesting question, because it is such an archetypal, community-oriented, close to the ground, cohesive kind of investment. But why is it struggling quite so much, Vidhya, to get mainstream attention?
I think Lyn's touched on some of the challenges of investing in community shares, but actually, if I look at the poll, what I'm thinking is more, we need to build more pipeline. Actually, there need to be more opportunities for this kind of investment, because the demand is clearly there, but the pipeline isn't necessarily as strong as it needs to be. Contingent on organisations like Power to Change, who can build some of that pipeline, do the bursaries and the things that we can do to get the share offers sort of ready, so that Cazenove and other kind of wealth managers can have more options in the market. So I don't know whether we need to make this easier to do, and that, because there clearly is quite a lot of demand, if that poll is anything to go by. There's more capital looking for these kinds of opportunities than there are currently opportunities. You know, I don't think it's ever going to be, you know, there's lots of the restrictions on, you know, the scale of investment, etc., probably make this not, you know, it's not going to be the first choice, I think, in many ways, but I think there's a lot more demand than we're able to meet now.
So Lyn, how do you see, I mean, what would you recommend to get community shares mainstreamed? Or how would that work?
Well, I think we need to be having conversations with clients about what they are and how they can benefit their local communities. So advisors are very good at talking, philanthropic advisors are very good about, you know, referring to community foundations, for example, for grant making, but perhaps we're not talking enough about how you can invest in your local community. And I think if we start having those conversations, and then that could grow that market, you know, to a bigger scale than it is at the moment. And
I mean, Daniel mentioned putting community shares into discretionary accounts. Is that possible? Can you do that? Can that be done? Is that practical? Because that's one way to integrate it, so that you don't have an individual trying to catch up with a investment whose window is closing. Is there something there?
So it definitely is possible, but I would say that it's still too small for most discretionary fund managers in terms of even a £600,000 investment, which is enormous. I know, I get it. It's just, but for larger wealth managers, that's actually still challenging, but for lots of reasons, I would say. But something to be ambitious for the future, I would say.
Yeah. Would that be an average size video? It was 600,000. That would be a big community share. I mean.
Yeah, that's on the larger end of.
Okay.
I don't know, Dan. What would you say? 200,000, like the average?
Well, I'd say about $500,000 is the average ambition, but you know, often you have a minimum close of, you know, you can cope with of less than that. And there are definitely some now that are actively raising millions. They tend to be in the renewable space, where that's a relatively well-trodden path. People, you know, really, you know, rightly are getting excited about their money directly contributing to tackling climate breakdown. So that's a real movement that people understand. I think people are slightly more divided about, you know, different types of social housing. Some people think that's, you know, the government's responsibility, but again, it's just a different asset class where you can earn an income. I mean, one of my questions for you, Lyn, actually, or the public, if there are any people who've got a view on this, is one of the limitations of community shares is there's no upside, so your shares don't go up in value. So you can get a return, a yield, but it doesn't, you know, you can't sell that share for £1.50 if you buy it for £1. And I think we've got quite used to this, if we're investing for the long term, this sort of sense that capital gain is something that we expect and deserve. And I don't know whether that's about the sort of game theory and this almost speculative joy that we get from, oh, maybe it's going to have gone up in value, rather than, you know, you're just going to get your 5.5% return or 3.5% return.
Just going to get your 5.5% return, Daniel. Yeah. Would be fantastic. In terms of our clients prepared to, you know, give up future financial capital gain in order to do good, I think they definitely are. And I think there's pots of capital out there that are very happy to have that model where they are getting a few percent a year, as long as the underlying is, you know, really delivering social change. I absolutely believe that money's there, and I talk to it all the time. So yeah, I don't think we need, you know, community shares to be able to deliver capital gain over the longer term. The yield is perfectly acceptable.
Let me take another question from the audience. Interesting that Daniel's mentioned the UN SDGs. This is from Hanan Ali. We are just embarking on embedding these at our organization. I wonder if anyone else is considering these also. Views on that, SDGs?
I think if you're not considering it, then you know you're missing out. I think everybody is defining things not terribly well always, but in the context of that, it's becoming a really useful common exercise. And whether you're doing it from an impact reporting perspective or whether you're doing it from a client journey, and I know our chair Karen Shackleton, who's advises for local authority pension funds, one of the exercises that she does with the pension funds trustees is go, you as individuals for this pension fund, prioritize these SDGs, and it creates a conversation, and that conversation creates purpose, and that purpose creates investment strategy, and then you can decide where you want to put some of your attention. So I just think it's a really powerful way of helping to navigate what's important to you. And you know, I've been in a room with half a dozen what I would call eco investors, and one of them is passionate about, we just need to build more wind turbines and put more solar panels out there, and the next person says, no, that's just the wrong thing to do, we need to create new technology that means it's more efficient, and then we can do it. And the next person goes, no, it's not about renewable energy, it's about driving behavior change amongst individuals so we use less energy. And then the next person says, no, it's about biodiversity. And you think, oh my gosh, I thought everyone had the same context, but the strength of opinion that's different. And it's just really, you have to have conversation in order to work out sometimes what's even important to you. And investing according to your own value set is harder. It's or at least it's slower than investing just for financial return. But my challenge is, if you haven't yet worked out what's important to you, then just going after financial return, you know, still doesn't answer that question. You're still going to have to make the financial return and then decide what you want to do with the money. So you know, spend some time working out what you want to do with the money.
Well, I'm glad we asked the question about SDGs, because apparently somebody has a view on it. So I've managed to run us out of time before we got to all the questions. Well, maybe one more.
Don't ask that to respond if you want to finish on time.
Sorry.
How can equity investments in CDFIs be encouraged? So responsible lenders, community development finance institutions. Are there ways in which the risks in equity investment can be mitigated? Does anybody have a view on that?
Go on, Dan.
You can do it.
Well, some CDFIs do this. So some CDFIs, community development finance institutions, many of them are set up as community benefit societies. They use that, what was an industrial and providence society. So they do issue shares, and there is a tax relief which is different from the SITR one I was talking about, called community investment tax relief, which is specifically for a pooled lending vehicle, and that provides a 5% return, a 5% tax relief for 5 years. So it's a 25% tax relief over that 5 years. But you've got to be sure about your tax position over the next 5 years, and it has some other complexities around how quickly you have to use the money and who holds that risk. So typically CDFIs, if that's their only form of capital, it's trickier. But you know, there are people using it. Again, it's this yield bearing equity, and often, the offers that I've seen have been 0% equity returning, or yielding equity, 0% yielding equity, with the 5% tax relief, with the hope that after that 5 years, those CDFIs will be strong enough to pay a small yield. That can work. It hasn't yet got the momentum it's going, but the really interesting thing is that corporates can invest. So if actually you've got a business paying tax, if you want to drive down your tax bill without being considered to be an evil tax avoider, you can invest in CDFIs as a business.
Okay, I'm going to draw the line under the questions, because I want to leave 1 minute for each of you to lead this group of people who are aspiring to move into 20% of their portfolios into impact. So a final piece of advice from each of you for this audience before we close. Vidhya?
Yeah, so I would just say, as Dan said, the first community share issue was in 1790. This is a really well-established way of raising capital of the union mill societies in the West Midlands. I think the other thing that's very strong about this way of investing is that these are things that you can touch and see, and that you can have a real link with these things in communities, even if it's not your community. I'm a shareholder of these community homes, but when those homes get built, I can go and see them. And that, I think, in terms of that relationship that Lyn talked about, I think that's incredibly powerful.
Great, thank you for that. Daniel?
I mean, I think we're in a moment in time where there's a lot of talk about build back better. And I think if we as individuals want to be part of that journey, then we've got to do more than just say, oh, I'd like to own some shares in an ESG fund where the money's not going to add anything new. And the challenge is for all of us to, decide if we want to go direct, then, sign up on FX, Triodos or Crowdfunder, and let's go and seek out those things. If you want portfolios or you want to go indirect and have a spread, then push your donor advised fund, push your financial advisors, declare that this is something that you're interested in, and put pressure on finding the way through. The government is interested in mobilizing private wealth to help, and we can't rely on the government to bail us all out. We have to be part of that journey. So yeah, it's on us.
Okay, thanks for that. I'm glad you mentioned crowdfunding, because I think crowdfunding is one of those people-powered tools that we haven't spent any time on today. That must be a future Impact Investing Institute webinar coming your way. The final word goes to Lyn.
Fantastic. So, I mean, I would say that advisors are in an amazing position to influence their clients, and they can really help improve the capital flows into this market. And I'm a really practical person. I believe in scale. And I think the way that they do that is they segment their client banks, really understand their clients, make sure that not everyone has this retail classification, because that really does help your optionality, and then align their advice and their investment processes around some of the things we've talked about today, and start talking to clients about this really, really fascinating area.
Thank you, Lyn, and thank you. I'd really like to say thank you to Vidhya, Alakeson, Daniel Brewer, and Lyn Tomlinson for some amazing insights on impact investing in the people-powered version. Thank you very much for joining us. You've been fantastic. And I'd also like to say thank you to the audience for joining us today. And I hope you'll join us at the Impact Investing Institute for a future webinar. So thanks everybody, and goodbye. Stay safe.